Hello and welcome to the program. I'm Ladi Williams. First off, let's take a look at the markets starting in Africa. The NGX remains unchanged today, continuing the bearish trend we saw in the week, while the GSE index is not looking so good. It's down about 0.07%, though marginal. In North Africa, the EGX 30 is in the green, up 0.88%, while Kenya closed yesterday's session down even more by 1.14%. And in the Middle East, it's mostly green across markets we track. In the UAE, the Abu Dhabi index is significantly up by 1.50%, with the Dubai index also up by 1.05%. In other regions, the Saudi Arabia index and Qatari index are both up 0.43 and 1.37% respectively, all green in the Middle East. Talking about the markets we track there. Moving on now to Europe, the big story in Germany is that flows have resumed down the Nord Stream 1 gas pipeline from Russia, but at a reduced capacity. The IMF has warned Europe that its economies face a big hit if they don't prepare for a complete shutdown of Russian gas. Let's talk to Rob Watts right there in Berlin. Great to have you, Rob. So flows resumed down the Nord Stream 1 pipeline this morning. Is there a lot of relief in Europe right now?
Well, there is relief because there was a growing feeling that Moscow might take this opportunity to punish the EU for its sanctions against Russia and keep the taps turned off. That hasn't happened. Gas is flowing once again, but it is at a reduced rate. It's the same reduced rate as before the pipeline was shut down for the last 10 days for maintenance work. The Russians say they reduced the rate because of repair work being carried out on a turbine. But Germany says that's nonsense because that turbine wasn't even due to be in use. So from the German and EU point of view, Moscow is continuing to deliberately choke flows through the most important gas link between Russia and the EU. And that is still something to worry about. Russia appears to be using its gas supplies to Europe as a weapon as such, and right now is testing the water to see what sort of an impact cutting supplies to Europe has. The answer is that it has resulted in European countries scrambling to reduce their energy needs and to find new sources of energy.
Right, and talking about impact now, what economic impact can we expect from a shut-off of Russian gas to European countries?
Well, the impact would be major. Before the war, the EU was getting 40% of its gas from Russia. It's reduced that by around a quarter since then. But Germany, for example, is still getting over a third of its gas from the Russians. That leaves countries like Germany very exposed to an energy shortage should the Russians decide to halt exports to the EU altogether. This week, the International Monetary Fund set out what it thinks a sudden stop to Russian gas supplies would look like for Europe. And it wasn't pretty. Not only would there be gas shortages, but also bottlenecks as countries scrambled to secure a share of scant supplies. Central and Eastern European countries will be looking at shortfalls of up to 40% in gas, according to the International Monetary Fund. And as a result of things like loss of production, economies would shrink. Germany could lose 3% of its GDP, according to the IMF. And Hungary, the most reliant on Russian gas of all the EU countries, could lose 6% of its GDP, or even more. So yesterday, the EU published its plan to reduce its energy needs and to lessen the potential impact of a stop to Russian gas imports. It's advising member states to reduce their usage by 15%.
Yeah, quite a tough decision for those countries to make. But the European Central Bank is taking its interest rates decision. What are you expecting?
Well, it is expected to hike interest rates for the first time since 2011. That's why it has been so hotly anticipated by markets. The big question to be settled today is how much that interest rates hike will be. It's thought the ECB may well opt for a 0.5 percentage points rates rise rather than the previously expected lower 0.25%. That major decision for markets is also falling on the same day that the future of Italy's Prime Minister looks all but over, having attempted to resign last week. Mario Draghi received another blow to his leadership yesterday after his coalition partners failed to heed his call for unity. So we have this uncertainty at the head of the government, a very influential European economy. That's just another thing for investors to contend with during Thursday. So European stocks held steady in early trading, edging actually to the positive side as they await that ECB decision and to learn the fate of Italy's PM.
Right, quite a lot to unpack there. Thank you so much, Rob Watts, right there in Berlin. Let's head on to the UK now. We have Juliana standing by right there. So, Juliana, all eyes still on the ECB at this point. How's it looking in the UK?
Well, how it's looking in the UK is that the ECB decision has come in. I believe it came in at about 1:15 just a few minutes ago, and they have decided to raise interest rates by 0.5%. Now, earlier in the week, I think it was touted that it could be risen by 0.25%, but they've gone much further than that. So basically, interest rates in the zone are flat now at 0%, which is still much, much lower than any other industrialized nation. Of course, we know they've been under significant pressure because inflation is skyrocketing across the world. We've had inflation figures earlier this week from the UK showing that's at a fresh 40-year high of 9.4%. And I believe in the Eurozone, on average, it's about 8.6%. But because there are 27 different member states, it is very different everywhere. I think one of the key messages, although, of course, I haven't had the time to go through Christine Lagarde's notes, is about a new tool that they are going to use to measure how they raise interest rates in the future. I believe it's called this anti-fragmentation tool. And the reason why this is so significant is because, of course, if our viewers cast their minds back a decade ago when we had that Eurozone debt crisis involving Greece, this was an issue. Of course, you're much wealthier if you're in the north of Europe than you are in the south. So it's been a huge a balancing act for Christine Lagarde to try and tread, which I believe many people say she has done particularly well, because there are so many issues that are affecting the European continent at the moment. I think the most pressing one is what is happening in Italy, which is the third largest state after Germany and France. Mario Draghi, the former ECB president, has actually resigned. His resignation has been accepted. So there is no government at the moment. What does this mean for the Italian economy? And if they do get a far-right candidate, which a lot of the pundits are suggesting, that is really going to affect how they see the ECB's decision. And then, of course, as you were just discussing in Berlin there, the Nord Stream pipeline, yes, it has been resumed, but what are the knock-on effects on the Eurozone economy if Vladimir Putin sticks to his word and starts depleting supplies to Europe? So big day, very dramatic announcement. And just to confirm, the ECB have at 1:15 for the first time in 11 years raised their interest rate from 0.5% to zero.
Right. Well, we'll see how the euro actually reacts to that. But how are the markets in the UK reacting to it right now? This data is slightly backdated, but the all share is down 0.22%. The FTSE 100 down by 0.47%, and the FTSE 250, the domestic market, doing pretty well, up by 1.12%. I think we've had a wave of trading updates that have been quite positive. In the currencies market, the British pound is currently trading down again on the US dollar by 0.05%, down 2 against the euro by 0.16%, and down on the Japanese yen by 0.10%, Laddie. And another data coming in from the UK that said the UK debt interest payments reached a record high. I'm guessing it's inflation stoking that.
You're absolutely right, Laddie. It is inflation. We've had UK government debt data from the Office for National Statistics showing that in June our debt pile, the interest of our debt was up £22 billion, and this is £4 billion higher than it was in June last year. That's definitely sent a shiver down the Treasury's back, because, of course, this money's got to be paid back. And it's now opened a wider discussion about the contest to be the next leader of the Conservative Party and ultimately the next UK Prime Minister, which we will be having on the 5th of September. It is Liz Truss and the former Chancellor Rishi Sunak going head to head. We know that Rishi Sunak Sunak has been accused of tightening the purse, lifting taxes when every other G7 nation has decided not to do so. But then Liz Truss has been going on the campaign trail telling Conservative Party members that she is going to lower taxes. And now, because of this debt pile that's just been announced, a lot of observers would say that is really not the way to go, because debt is increasing. So very interesting data today that the Rishi Sunak camp, of course, are going to run with, because he is seen as, somebody that wants to tidy up the coffers and not open them loose for erratic spending.
All right, all eyes on the next PM. Thank you so much, Juliana, for the update.
Thank you.
All right, now let's move on to other markets. Now we see Japan's benchmark index rose modestly today after the Bank of Japan kept rates on hold, while Asia markets were mixed. The Nikkei 225 in Japan reversed earlier losses to close at 0.44% higher at 27,803 points, while the Topix index was up 0.21% at 1,950 points after the central bank's decision was announced. In Australia, the S&P ASX 200 gained 0.52% to 6,794 points. Rio Tinto shares fell 2.01% after the company said it will pay the Australian Taxation Office an additional tax of 13 million Australian dollars over a dispute. Rio previously paid the ATO 378 million Australian dollars. South Korea's Kospi gained 0.93% to 2,409 points, and the Kosdaq was 0.56% higher at 795.15 points. And stock futures dipped today after a batch of mixed corporate earnings from companies such as Tesla and aluminum producer Alcoa. Futures tied to the Dow Jones Industrial Average shed 99 points, and the S&P 500 futures ticked down by 0.2%, while the Nasdaq 100 futures dipped 0.0, went up by 0.01%. Shares of Alcoa and CSX jumped in the pre-market over the company's beat expectations, and while Tesla shares were choppy after the automaker reported stronger than expected earnings, but shrinking automotive gross margins of early trade. The stock was up about 2.6% earlier in the day. And oil prices fell more than $3 today after higher U.S. gasoline stockpiles stoked demand worries, and returning energy supply from Libya and Russia also eased supply concerns. Brent crude futures dropped about $4.29 to $102.65 a barrel after slipping 0.4% in the previous session. U.S. WTI crude futures fell $4.15 to $95.73 a barrel, following a 1.9% drop on Wednesday. Oil futures trading volumes have been thin and prices volatile as traders have to square tighter supply because of the loss of Russian barrels following the country's invasion of Ukraine, with recessionary worries about weaker energy demand. According to the Economic Intelligence Unit, EIU, global natural gas demand will contract by 2.8% in 2022 to 3.903 billion cubic feet from 4,000 billion cubic feet in 2021. Now let's get more now from Ifeanyi Otisi, analyst, financial derivatives company. Join us, Raya. Great to have you.
Thank you for having me.
So the EIU forecasts that the European demand for Russian gas will fall by 4.1% in 2022 and further decline by 5.3% in 2023 as economic sanctions squeeze industrial output. Do you agree with this forecast?
Yes, I do. And my reason for agreeing with these forecasts relates to certain factors. So we've seen higher prices recently. We've also seen supply disruptions due to the war in Ukraine, and which has led to economic sanctions being imposed on Russia. Another thing we've seen right now is the COVID-19 lockdown restrictions imposed in China, which has had economic effects on the country. So we've seen that with the lockdowns in place, businesses and factories or industries who ordinarily would have been in operation have had to either cease operation or limit operations. And as a result, they're not relying on natural gas to power their equipment and their machinery. So this invariably will lead to a reduction in demand for natural gas in China. Another thing is the European Commission has set targets to curb dependence on Russian gas in the near future. So the idea is, like I said earlier, the economic sanctions have been imposed on Russia to further impose all of that. They've tried to set targets to reduce the amount of natural gas that European countries need or require. So they're looking for alternative sources to meet domestic demand. Another thing is, I don't know if you've heard of this, but the heat wave that's currently being experienced in certain European countries. Obviously, we know that gas is used to power heaters during the colder months, but now that we're in warmer months, we don't need gas. So that's reduced the demand on natural gas. But bear in mind, colder months are approaching. So generally, it is anticipated that countries would increase or need more natural gas to power their heaters during the colder months.
And they're also needing gas at this point because of the heat wave. We're seeing across Europe. So now they're even needing gas at this point, too. It's quite a tough place to be for Europe. But we see now that the Nord Stream 1, pipeline, has been opened, but, at a lower capacity at this point. But do you see Putin actually honoring, his pledge, with getting that supply to Europe?
Well, the thing is, let's give him the benefits of the doubt. Yesterday, European countries who would have been affected, who are affected by the performance of Nord Stream 1, despite Putin's assurance, they feared that he wouldn't keep to his word. And they feared that the pipeline wouldn't be restarted according to schedule. And they had to find other sources to meet short-term demand. But then he's kept to his word. This morning, the pipeline was restarted. So he did tell us yesterday that the gas volumes that would be transmitted through the pipelines will reduce. We've seen lower volumes now. And I mean, it's something that he said. So we would anticipate and hope that in the near future, at least it goes back up to 40%, because before the shutdown, the capacity was reduced by 40%. So we're hoping at least it gets back to 40% and then further increases in the near future.
And there's also that debate, about how clean, natural gas is. They say it's, still has, some dirty aspects, to production. What do you think?
Well, call it what it is. It's associated gas. And if you think about the process, it's a fossil fuel. So the thing about it is some people have argued that irrespective of that fact, it is a cleaner fuel because it emits lower carbon volumes. So that's an argument that I tend to subscribe to. The thing is, if we buy that and if the European Union labels natural gas as a clean source of energy, Nigeria as a gas producing country has a lot to gain. So we would see economic diversification across Nigeria and other African countries that produce gas. We would also see increase in job opportunities. We would see foreign investments in our natural gas reserves, and the revenue that's generated from that can be used to build infrastructure such as pipelines, ports, and even roadways. And a lot of economic benefits for Nigeria. So I'm of the school of thought that it should be labeled as a cleaner source of energy.
Even though the what they used to make it sometimes can be still from fossil fuels at the end of the day.
Yeah.
Well, at the end of the day, Europe have to make a tough decision. We're seeing some of them actually, fall back to coal at this point. But we'll see if Russia keeps, getting that supply to Europe at this point. Thank you so much, Ifeanyi Otisi, analyst at Financial Derivatives Company. It was great having you.
Thank you for having me.
All right, now moving on to other stories. Now, the IMF has recommended that special safeguards for M-Pesa and banks from unfair competition by the planned digital shilling by the Central Bank of Kenya be the proposed central bank of digital currency, which is currently under public discussion, is seen as a competitor to mobile money down the road, especially in its ability to lower the transaction costs. May also pose some relative threat to banks because it will enable customers to bypass lenders, with the CBK taking on a new role of keeping track of holdings, transactions, and settlements. The CBDC is being eyed mainly to ease cross-border payments and to complement mobile money and local digital payment space. With these competition concerns, the IMF is now urging caution as the CBK progress with preparation for the possible adoption of the digital currency, saying the CBDC would complement existing private sector digital money. And Egypt began the construction of the first reactor, El Dabba plant, the country's first nuclear power plant to generate electricity. That was stated by the Power Plants Authority. The plant is located in the northwestern governorate of Marsa Mathur. Minister of Electricity and Renewable Energy and the General Director of Russia's State Atomic Energy Corporation attended the ceremony at the plant, giving the green light to start construction works. And there are also plans that reactors will comply with the International Atomic Energy Agency's safety measurements. It can endure earthquakes and airplane crashes, and added that the reactor's operating span may extend to 60 years. Funding for the project is based on governmental financial agreements. Loans will be acquired after operating the plant and collecting revenues from electricity generation, and the project is expected to generate net revenues of $264 billion for the state treasury over 60 years. And Mulk International, Sharjah-based industrial conglomerate, has begun to build a $500 million high-tech park in Zimbabwe that is expected to boost the country's economic development. Zim Cyber City is being built in Mount Hamden, on the outskirts of the capital Harare, as the first large-scale investment by a UAE-based business entity in the African nation. The project also marks the first real estate investment channel through the Zimbabwe Global Investment Special Economic Zone program. The development spread across more than 232,000 square meters, includes government residential and commercial buildings. It was granted an exclusive license to develop a special economic zone dedicated to blockchain and digital assets. And that's it on Business Incorporated. Thank you for watching. I'm Ladi Williams. Bye for now.